Hi there, this is Nick Radge from the Chartist, and today I thought I'd just have a chat about some of the markets, what's going on, have a look at 2022, and see what a pretty tough year that actually was. So, what we have here in front of us is the Australian ASX 200 index. This is actually without dividends. You can see that we spent a lot of time below the 200-day moving average, quite a considerable amount of time actually below that 200-day moving average. And during the year, we had a 16% drawdown from the highs down to these lows down here. Now, the ASX 200 is a cap-weighted index. If we actually equal weight the index, it would have fallen closer to 23%. So a pretty choppy environment there, making trading very, very difficult for the whole year. And as I said, a lot of the time spent below that 200-day moving average, which tends to be a good indicator of the trend. You can see that trend now is pretty well stabilized. The market has come back very, very nicely. Indeed, this recovery has almost recovered something like 80% of this decline, which when we look at the S&P 500 very shortly is a pretty damn good effort. Other interesting point here on this chart to consider is that when we put dividends back in, I won't put that chart up at the moment, but when we add dividends back in, the Australian market is actually back at all-time highs. So some pretty interesting stuff there, but from a trading perspective, very difficult year last year, very, very choppy. These kinds of things happen. Trend following, very difficult in that environment simply because you get taken in and taken out, taken in, taken out, death by 1,000 cuts, if you like. So we actually kept reasonably quiet. Our momentum strategies are currently 100% invested. Some of our absolute trend following strategies struggling to actually get back in, and that's mainly because outside of the large caps, a lot of these small caps are still really, really struggling. If we have a look at some of those performers, for example, during the year, which has helped the broader market, the number one is BHP, and you can see that it's at all-time highs. Big zone of resistance through here, $49, $48 has been broken through just recently, but a very, very strong performance in the last quarter for BHP, and obviously being such a large cap stock, it's got a big influence on the market, and that's why the cap side of the market is actually looking considerably better than the broader state of the market. Some of the other stocks that are doing reasonably well, AMP is one we've been tracking for some time, and if I just squeeze this up here, you can see it's broken out of that big base. Potentially the longer the base, the better the breakout. So we're looking for AMP to move up towards around that $1.60 mark, simply on doubling of that base. AMP sits in a couple of our portfolios at the moment, and it's shown very, very good relative strength of late. Talking of relative strength, let's take a look at some of the strongest stocks in the Australian market over the last 100 or so days. You can see here we've got a lot of mining stocks, coal stocks in there, mining support services. That's really where we're at with that. If we go down to shorter windows, gold really starts to stand out actually in the shorter term windows. So they're the strongest stocks. Some of these are in our portfolios: Stanmore Resources, Polynovo, Whitehaven, Neuron Pharmaceuticals, Myer, Pilbara has been a great performer. So a lot of good stocks in there, trending very, very nicely and not far away from all-time highs. If we flip this around and take a look at the worst performing stocks over the last 100 days or so, obviously we've got none of these. They are going down and they don't particularly look healthy. But interestingly, some of these were leaders not too far or not too much recently. So that's how the market flips and changes, but we're only focused on those top stocks at the moment. Let's take a look at the US market. Here we've got the S&P 500, and you can see pretty much the whole of 2022 was really, really choppy, downside affair that we can see right there. Now, this is not overly bearish. This choppy kind of price action tends to be more corrective in nature than impulsive, which would be suggesting further downside bearishness. That's not to say it's going to turn around and go straight up straight away, but it gives me confidence that this is just a pause in what would be a much longer term macro kind of bullish market. So a good solid pause over the year. It's very, very healthy. Nothing wrong with that at all. Still difficult year to trade. The good news here is that we've really been tracking sideways for the last 6 months or so. So we're trying to put in a bit of a basing pattern. Obviously, market waiting on earnings at the moment, so we'll see how they flow through over the next couple of weeks. But the S&P, you can see, fell about 27.5% during this recent drawdown, and it's only recovered probably a very small portion. I think that's about 30-40% there. So compared to the ASX, we're a long way off in terms of relative strength recovering in the US market. Specifically, this is the S&P 500. If we take a look at the NASDAQ, even a little bit more of an uncomfortable story there as well. Current decline about 37.5% off these recent highs up here. And you can see the recovery so far is pretty small. But again, I stress some sideways price action going on there, which is reasonably positive. And again, this choppy price action down is not too gloomy from a trend perspective. The choppy price action tends to be corrective, not impulsive, which means we're having a nice pause in the market. That's not to say that it can't last another year or something like that. I have no idea. But, you know, for all intents, downside is probably more or less limited now to what we've already seen, which is a good sign. If we take a look at the strongest stocks in the S&P 500, a lot of oil and gas stocks in there. They're probably taking up most of the space. A few utilities, a few pharmaceuticals, but really oil and gas is where it's at the moment. So that's the S&P 500 stocks, strongest stocks. If we flip that around and take a look at the weakest ones, a lot of banks, a lot of medical equipment in there, a few REITs, semiconductors, that kind of stuff. This is part of the market you don't want to be in there. Interestingly, there you go, Tesla, which was the giant stock of 2020. That's where we made all our money back in 2020 and early 2021. And that is now the second worst performer in the S&P 500. So we don't want to fall in love with them. We want to ride them up. We don't want to ride them down again. So look, who knows what happens with Tesla? Could turn around again, but we're certainly not having a part of it at the moment. Just coming back to this NASDAQ chart right here, you can see it's fallen 37.5%. But the 200-day moving average, that is firmly trending down here. Good recovery, though, on the last session's trading there. It started to come back up again after gapping lower, which is a good sign. But all in all, we're going to need to see that trend change convincingly before we start getting involved. Our trade long-term weekly portfolio is currently fully invested, but our monthly portfolio is sitting in cash. So that's the whole idea of diversification across the different time zones or time frames there to get us some exposure, a little bit more aggressive if you like. And if that pays off, that's great. So if we have a quick look at Tesla while we were talking about that 1 second ago, yeah, that's a pretty dire situation right there. That stock has fallen a long way. You can see back up near the highs up here, we were over the $400 mark. And we're now just tagged down there towards $100. I guess buying Twitter is not the smartest thing, but anyway, he's a bit of a Fruit Loop in that respect. But we'll see that what happens with this stock. No signs of that turning around at the moment. Ideally, what we want to see is some sideways price action over the next 4 or 5 months before we get really confident that that thing can turn around. But at the moment, that trend is firmly down. So that's pretty well it for the markets. All in all, I think a lot of the damage has been done. 2022 was very difficult for a lot of investors, a lot of the big boys around the place. But I think the worst is now behind us. So we're slowly getting involved again after sitting it out for much of 2022 in certain portfolios. And I look forward to 2023 being somewhat a better year than what we've had before. So thanks for your time. And feel free to send me any questions at all.